Hi, everybody. My name is Anna, and I am a solopreneur based in a suburb of Chicago. I've been running my business for full time for about 3 years, but longer if you include the time that I was running side by side with other work that I was doing. And our topic today is taxes and budgeting for solopreneurs. And I'm going to be covering kind of the budget part of how I budget for different things in my business. I'll turn it over to Hannah to introduce herself because she's going to be taking care of the tax part.
Awesome. Thanks, Anna. Hi. I am like you, a solo entrepreneur. And I have a little bit of a weird story. I'm a professional artist. I'm trained as a painter. I actually was a professor of painting at Boston University, but long story short, I was so frustrated at being a creative person. An artist is just a freelancer, like their taxes are self-employed taxes. And I was so frustrated at how accountants treated me that I eventually went back to school to study taxes and accounting and bring it to creative-minded people who I felt like the accountants kind of would see, they would understand me if I could speak like I had gone to business school and like money was my one and only focus in life, and every decision I made was like an economic robot. But as a person with like a real mission and like doing things for reasons of love and community and creativity and making the world a better place, like the accountant just did not get me. So that is why I founded Sunlight Tax. And I'm a tax educator for self-employed people, especially people who've got a mission, like trying to do something in life. Sure, make a lot of money, but, do it as you make the world a better place and fulfill a mission. So
I
that's
love
a little
that.
bit about me.
I am going to very quick share just one slide kind of intro about what we're going to cover in this session, but then it's really going to be just a conversation back and forth between Hannah and myself as we share different parts of our expertise. So real quick. And now Zoom is like covering the button on my share screen in Canva. So it's like I need to get there. Um, So, what we're going to cover today, we're going to start with some misconceptions about taxes and specifically how it applies to solopreneurs. And Hannah's going to dig into further how self employment taxes work because they are different. And I know from my own experience that you can get really surprised with tax bills if you aren't familiar with what goes into that. When to consider a sub S Corp, which is a specific entity in the United States, and then basically budgeting and how to actually plan. So there's a planning piece of knowing how much you're going to owe, and then also budgeting so that you're ready to pay your taxes. So then we're going to talk about that as well. And at the end, have a Q&A. So feel free to drop questions in the chat. But then at the end, we'll also, if you would prefer to ask a live question if you're on the call, do that and we'll go from there. So I'm going to stop that share and go back to our faces. Um, so to get started, Hannah, and Hannah and I have talked before. I actually interviewed her for my Substack and she had some great tips for things that she thinks that people don't understand as self-employed people about taxes. So Hannah, why don't you start there? What do you think are
Sure.
some big conceptions?
Yeah, I think probably the two biggest misconceptions when you are working for yourself, when you're self-employed, is that, one, probably most of you on this call do understand this, but I do see that sometimes people don't realize that they are treated like a business under US tax law. Being self-employed is synonymous with being a business under US tax law. So there's not like you're not a business until you register somewhere, form an LLC, make a profit, make a certain amount of profit. Those are irrelevant items to the IRS. You're already a business to the IRS. So that's important. Second thing that's super important, self-employment tax. It's a bigger factor in your tax bill than you realize. And in fact, I'd love to take a second to just illustrate that on the board. But the second thing I want to mention is also estimated quarterly taxes. and this actually ties into self-employment tax. Your taxes are probably a little higher than you thought they were because of self-employment tax, and you have to pay them every quarter. You are not. A lot of people set aside, like, get the memo that they should be setting aside money for taxes, but they don't actually pay on April 15th, June 15th, September 15th, and January 15th. But the law requires that you do that. So you are incurring penalties if you don't do that, and you are supposed to be. So that's a thing I want to just caution you to actually make the payment, and not just keep it separated in a bank account. So if I just do a little
add that it's like insult to injury that you owe for your annual taxes and your quarterly taxes on the same day. Like, who came up with that?
Well, here's the thing though. If you've been paying a quarter of your tax bill
Sure.
every quarter, in theory, you have nothing that you owe on April 15th.
That's true. But you know what I mean? Like, conceptually, to me, it's like two things I've got to keep track of on the same day.
For sure. For sure. I think it's actually like kind of switching your operating understanding from it being something you catch up on and owe all on April 15th to something you stay ahead of with quarterly taxes. And then the little bit of like adjustment for overpayment, underpayment, that is due on April 15th. And hopefully it's, not very big.
Yeah.
But yes, the first year you learn this can be so painful.
Yeah.
Just that reason.
Yeah. You're like, oh my gosh, this is awful.
Oh my gosh. Yes. So let me do like a really quick, Anna, keep me on time because I know I know you like to run a tight ship. So when you're self-employed, let's just talk, or actually, if you're not self-employed, if you're a W-2 employee, let me just illustrate how the taxes work, because that translates to how self-employment taxes work, okay? The tax system is treating both of these types of earned income the same. So when you're an employee, you got 7.65% of your paycheck that you're paid every pay period automatically taken out by your employer and paid to the U.S. Treasury to go to your Medicare and Social Security. There's no opt-in here, right? You don't opt in and you can't opt out. So this, a lot of people never think about because they don't have to do anything about it. Now, the other thing is that that's not the only Medicare and Social Security that you have accumulating. Your boss matches what comes out of your paycheck, and the boss half is called payroll tax. So they are paying in a matching item. On top of those things, which are automatic and based on the pay at this job, you also owe federal income tax. Those rates range from 0 to 37%. And you owe state income tax. And in some very special cities, like New York, you might owe a city tax as well. It's a little more rare, but it could be you. So that's employee, right? When you're an employee. This one, federal income tax, you probably have a little bit of awareness in your head because all of us have probably had a job as an employee, barista at Starbucks, whatever we did. You've probably had to fill out that piece of paperwork called a W-4, which told your boss how much withholding you wanted from your paycheck. That W-4 is really only talking about your federal income tax rate because this number is not based only on the pay of that job. This number is based on all the income you have, which might include your freelance income, might include your spouse's income, might include rental income, royalty income, other types of income. So that's why you have to tell your boss what withholding you want from your paycheck. And it's also why I think that one kind of sticks in our brain a little bit, whereas this one does not, because you never have to look at it, right?
Right.
So if you move that over to being self-employed, well, now we're basically just going to rinse and repeat. It's actually exactly the same thing. It's just that now you wake up to this part, right? So you have to pay that same 7.65%. Now, very important difference. These guys owe tax on 100% of their income, minus like a little around the edges for a retirement fund, maybe workplace benefits, but pretty much all their pay is subject to all this tax. You're different because as a self-employed person, you are a business and therefore entitled to take business deductions. So when we do these numbers, it's on profit, not on revenue. Okay. You have to report all your revenue. That's mandatory. But you get to report expenses and lower the taxable income really dramatically, right? So that's a big deal. By the way, I've got some great resources for you on deductions. I have a visual guide. So we're going to link up to this visual guide to tax deductions.
And that's already, for anybody listening, that is already scheduled to go out like right after we end. So it will land in your inbox about 10 minutes after we're finished. So
Love it. Love it. Also for MES is what your title says in Zoom, but in Italy, these
Yes,
deductions,
Mario.
I don't know how they apply to Italian law. These are definitely US tax law based, just FYI.
Not is new. Is new.
All right. So real quick, just to close this loop here, when you're self-employed on your profit, so keep in mind, you got to do a little bookkeeping to even know what your profit is, but you owe that exact same employee contribution. 7.65% of your profit goes to the Treasury to pay into your Medicare and Social Security, and you're the boss. So you also owe the boss half, okay? That is the place where people underestimate their taxes. When you add those together, it's 15.3% of your profit that you have to pay in. That is called self-employment tax. Okay, that's the biggie. That is why people underestimate their taxes when they're self-employed. It's a really big factor in your tax bill, and it may be new to you. There's no tax education in this country, so it's not your fault. It's just maybe a big surprise. So those elements, effectively, it's exactly the same as over here. It's just that you may never have consciously thought about the Medicare and Social Security you're paying. So that hopefully will kind of cement it in your brain. Happy for questions later, but Anna, I hope I didn't.
yeah, I actually have one just because I've heard this advice and I'm just curious what you would say. So I've heard people say, set aside like 25 to 30% for taxes. And I assume then I'm a sub S Corp, which we're going to get to. So it's a little different for me. But and so I assume people are thinking, okay, so if I owe, my federal tax is going to be like 15% on my income. Plus I've got this self-employment tax of another 15%. That's how they're arriving at that 30%. Is that what you typically see? And is that the advice you'd suggest, or is it a little trickier than that?
It is trickier, of course.
Of course it is.
I mean, that's not a bad baseline. I think roughly it's,
Probably
just
about.
understand like what are your business expenses versus your revenue? And are those exactly the same as mine? Probably not,
No.
right? So there can be huge variation in how profitable. It's based on your profit. So you just, that's going to vary one person to the next. If you're basing it on revenue, you could be dramatically off
Right.
because, maybe you're not even profitable. You won't owe anything then. So, yeah.
So let's dig then a little, because I know you have a lot of information on this, on what it means to be a sub S Corp. And I'll just quickly share, I started my freelancing journey as a sole proprietor, basically an individual doing a business, exactly like you said. And then about 2 years ago, I made the switch and now I operate as a sub S Corp, which dramatically changes a lot of things. And so why don't you talk a little bit about what does that do and why people might want to make that switch?
Yeah. So, part of why I illustrated this is because this is where the savings comes in for an S Corp. So now we can kind of point to numbers. I'm going to call it an S Corp. You're correct. It is also called a sub S.
I come from a banking background, so I've called it a sub S Corp my whole life, but yes.
Totally fine. Because it comes from subchapter S of the Internal Revenue Code. So when you're self-employed, when you are paying 15.3% of your profit to the IRS, on top of your federal income tax rate, let's say that's a 10-20% rate, that can start to be a large proportion of your profit, right? It can feel at a certain, I'm going to give you the cutoff. Around $60,000 of profit is where I would begin to start doing the math of like, am I going to save money if I do a sub corp? Sorry. Now I'm getting
No, I got you.
an S Corp versus just being filing with a Schedule C, which is where you are by default when you do freelance work. So if you don't make any election, you're filing as just self-employment on a Schedule C on your individual tax return, 1040. So the difference so the very important thing to know is that if you're not making $50,000, $60,000 of profit, not revenue, profit after expenses, then it's not worth your time, right? There are some additional expenses of having an S Corp, and it's a part that the accountants tend to gloss over, right? Because it's accounting fees, right? So let's be super clear. You're going to pay a lot more in accounting fees when you have an S Corp, and you're going to need them, right? You're not going to be able to DIY your S Corp accounting because I'm just going to be honest with you. It's not a DIY situation. So, but once you make $100,000 in profit, $120,000 in profit, you're starting to get into a land where you're going to have real savings with an S Corp. So I can show you the math of what that savings is. But let me just give you a little warning. Please don't everybody run out and form an S Corp because one, you're stuck with it for 5 years. You can't just undo it after a year, okay? You're stuck with it and the accounting fees and the separate corporate tax return due March 15th on top of your April 15th personal tax return, right? That's a lot. And also, if you're in New York in particular, don't even bother. It's just not worth it. New York actually taxes back all the benefit of an S Corp. So now you only have the expenses and none of the benefits. So New York, forget it. There are some other states that have laws that will tax back some of the benefit, maybe not all of it. So it's worth checking your state rules before you run out and do it. I'll warn you that those Instagram ads, you've seen them, that are like, you could save tons of money if you formed an S Corp. You might be paying too much. They don't really check carefully what state you're in. I don't find they do the due diligence. And I tell you this because I'm the person people call when they did an S Corp they shouldn't have. And they're like, how do I fix this awful situation? Don't get into it is my advice. Okay. So to form an S Corp, you do a filing with the IRS. You have to actually mother may I from the IRS. And you are not an S Corp until they send you a letter and give you the approval. You have to save that letter. But what the S Corp does is it basically shifts the structure of your business. So instead of paying these layers of tax on 100% of your profit, you actually shift to partly having your income structured as a payment through W-2, like payroll, okay? So you will actually pay the same taxes on what you pay yourself. You're actually going to be required to run payroll and pay yourself as an employee of your company. That is a requirement of an S Corp. By the way, you can't just form an S Corp and say, oh, I'm going to skip that part. That seems annoying. It's a requirement. And I've seen states come after people for unpaid workers' comp when they don't set up payroll and pay into the state system. So beware, this is not casual, okay? This is why one of the parameters to me before you do file for an S Corp status or elect to be an S Corp, you need to make sure you have the administrative capacity to set up payroll and make sure you stay on top of it because you are now going to be subject to employment law in your state, okay? That's not something you can skip. Okay, so you set up payroll. You're going to pay yourself as an employee. And what that means is you're going to actually have to register as an employer in your state. Again, this is a step you have to take. You may not skip. And then you set up payroll. I use Gusto and I have an affiliate link if anybody wants it, but that makes it pretty easy. It's the best software in my opinion. And you will now pay yourself as an employee. And what happens, you actually still are the employee and the employer here, but you'll actually get a paycheck and you will actually do this withholding, right? So effectively, you're still going to pay that same 15.3% because as a boss, you will now owe payroll tax on whatever you pay yourself, right? So the tax ends up the same on this portion. However, if you are, I don't have quite enough room here. Let's just say that your profit in your business is $100,000. Okay. So if you have $100,000 of profit and you are fully self-employed and you don't have an S Corp, you're going to owe 15.3% on 100,000. So that's 15,300. Technically, it's going to be less than that, but I'm going to skip that detail. In self-employment tax, let's say you had a 20% tax rate. That would be 20,000. That's a little high, honestly, probably a little lower than that, but okay. So you'll owe, in this scenario, you'll owe $25,300 in tax. I'm skipping state taxes. That's also a factor, but okay. If I form an S Corp and I set a pay for myself, I have to set a salary, and it has to be a reasonable salary. And the IRS will audit you if you say a reasonable salary is $2,000 a year, because that is not a reasonable salary. So you have to make it a legitimate, provable, reasonable salary. But given that, let's say that with this same profit of $100,000, I decide I'm going to pay myself $50,000 salary. Okay. So now $50,000 is subject to this same tax. So we can just cut that number in half. Let me get my calculator. In high school, I used to have nightmare that I was on the stage in the high school having to do math in front of my whole high school. And I find this so funny. This is now what I do for a living. I do my nightmare. Okay. So half of that would be $12,650. Okay. So you owe that. The other $50,000 in profit that you got, however, is just profit and not subject to this layer, right? The Medicare and Social Security layer, which you might call self-employment tax, you might call payroll tax and Medicare, Social Security. So this bit, one half of this, 15,300 would be $7,650. That's what you save. So you'll still owe $20,000 in income tax because you still owe income tax on all of your profit, but you will only pay half of the Medicare and Social Security in this scenario. Okay, so now what do we have? Did I do my math wrong up there? I totally did. Oh, shoot. That was 35 and I wrote 25 and then I did half of the wrong number. I apologize. Okay, 35,000. See, math on stage is not great for my brain. 3,300 divided by 2, 17,000. There we go. So that is half of that. Okay. And then I apologize. My brain is having a little moment here.
It's a lot, basically. It can be a lot.
I know what I did. Basically, you're only going to owe half of, sorry, I did it of the whole number, but I meant to do it just of here. You will owe $7,650 in payroll because you'll pay both sides of it. And you'll owe the same amount in federal income tax. So that would be $27,650. Okay. Apologies. So from 35,300 to 27,650. That is your savings. And that savings is this, again, $7,650. Okay. So that's what you save. That's the savings of an S Corp. You will have a new tax return you have to do, and you probably need an accountant. Probably gonna be $1,000. And you also will need much more rigorous bookkeeping. You are going to have to actually include a profit and loss statement and a balance sheet with your tax filing. And so you need that to be accurate. So you may also need to hire a bookkeeper if you don't have one already.
And you pay, I use Gusto also, which is pretty minimum. It's $55 a month, I think, is what I'm paying for just myself. So compared to even when I add in the bookkeeping expense that I incurred when I became compared to the 1,000 saved, it was a big difference. So
yeah. Yeah. Big difference.
Yeah.
Yeah. And if you pay an accountant to run payroll for you, they're going to charge $100, $200. And if you're, just doing it yourself with Gusto, it is a big savings.
And it's not hard. Once it was set up, it just kind of like runs. I don't have to think about it too hard. So,
Yeah. Yeah,
so,
exactly.
so let's kick a little bit into the budget portion, of this session. And, so one thing that I wanted to touch on is what you talked about, which is savings for taxes. And what I suggest to people, when I talk to them is, because you know that you're going to need to make that payment quarterly, is to actually set aside money in a savings account so that you can draw from it. So I do that every month. I don't wait till the end of the quarter. I do it as I go along, as I look at like, okay, what was my actual profit for that month? And I set that aside in a savings account so that when I get to the quarter, I'm not scrambling to like find money to pay the IRS. And part of that also for budgeting is not only doing that, but also budgeting, for example, for like a rainy day fund. I do them both at the same time because I think something unexpected might happen. Maybe you owe more than you thought. Maybe one quarter is different. Maybe something happens. Like I had to take some time off last year for medical. So I do those at the same time. And I just consider that like an expense of my business. It's not an expense like the IRS, but that is part of my budget. Every single month, I'm like, what do I have to pay? I have to pay myself. I have to pay my business expenses. I have to pay my tax account, my savings account, and I have to pay my rainy day fund. Those are kind of my non-negotiables. And that just helps me figure out like what's left after those things happen. And I think that's where a lot of solopreneurs kind of maybe get not into trouble, but they don't think about it that way. They don't think of it as like a non-negotiable. Like you've got to take care of these things every month. Otherwise, you could get into a situation later where you find that you don't have enough money to cover something, whether it's taxes or whether it's something that comes up and you need to cover it.
Yeah. I love that. That's very smart. I really appreciate that approach.
Yeah. And then for me, then everything like left over. So after business expenses, paying myself, putting money aside for taxes, putting aside money for emergencies, that bit is now what's left to not play with, but that's what's left to work with in my business, right? So for me, sometimes that's putting some money into a savings account that I call business reinvestment. So for example, my computer croaked,
Ooh.
last year. And
Yeah.
so that's not a cheap thing to replace. So something, or maybe I want to take a course and it's pricier or something like that. Now I've got money just sitting there. So that's anything that's left after I've taken care of all of these other things in my budget. Then that basically goes into what I just call business reinvestment, and it just sits there
Love-
until I'm ready to use it in like whatever manner I see that I need. It's just sitting there.
Um, I think, I think one of the big things I want to just reiterate is like, there's not a tax education in the US, and a lot of people do not ever learn these rules in the abstract before the thing happens. The way that most people learn, in my experience, and I say this as, my experience preparing people's taxes who are freelance, is that they learn about quarterly taxes because they suddenly notice they've been paying interest for 3 years because they set this money aside, or maybe didn't even set the money aside, and they're paying interest on the unpaid balance. You don't need to pay interest on the unpaid balance if you simply kind of get on top of those quarterly deadlines and make the payments. You can avoid that. So I just want to kind of decrease the pressure on you. A little bit of tax education and tax literacy can save you a lot of money in penalties and interest. And the fact that you don't know it does not make you bad or broken. It makes you pretty normal. So,
Yeah.
yeah.
And the one thing that I'll add is I know budgeting often sounds like kind of like a hard math problem also, like why, but the tip that I give people is to come up with like a low, medium, and high budget. So like the low would be, what do you do if you have a low income month? What do you do in an average income month? And what do you do in a high? And during your low, you pull from your rainy day fund. You don't change anything. You set that money aside so you can just pull and then life just goes on. You don't have to stress about it. And during your high months, you put money into your rainy day fund more. So that way it's there when you need it. It takes a lot of time to set that up, especially if you're just barely breaking even. It took a long time for me to be able to get to that point. But then I was like, oh, cool, I have extra clients this month. I'm just going to stash that money aside. Makes it a lot easier to adjust when your income is really variable, which is so hard for people running a solo business.
That's really wise. I love that. Yeah. I'm guessing that if you're watching this, that you probably have a separate business, a separate account.
Hopefully.
But if you don't, that is step number one.
Mhm.
If you are like losing track of deductions and stuff, that separate business account for the expenses of your business, that is absolutely key first step. And will help you never miss a deduction and never misplace stuff. And then your bookkeeping just comes from your bank statement and not loose receipts. So if you are just like, not where Anna is, but like just coming into this, that is a key first step that really clears a lot of the cobwebs away.
Separate bank account and separate credit card. Because like I have a business credit card. So like all of my business expenses go on the one credit card and then I just pay that off. And then it's just, it's the bank account and the credit card. And that's where all the business stuff lives.
Yeah. It makes life so much easier.
If you have a bookkeeper, your bookkeeper will thank you.
And charge you less. Charge you
Yeah.
less.
Because they're sorting through less.
Yeah, for sure.
Okay. Well, thank you to everyone.
Thanks so much, Anna. I really appreciate you hosting me. Thank you, everybody, for being here. And I hope you will grab that visual guide to your tax deductions that Anna is linking to. And for some tax literacy, I wrote the book, Taxes for Humans, which I hope will, I wrote it for people like us who didn't go to business school, who just need to know how to do our taxes and feel good about it. So it's a really great read. Awesome. Thanks so much, Anna. Great speaking to you.
Thank you.